All right, welcome to Kui's Investing in Retirement webinar. I'm Andrew Grinsell, the Head of Wealth here at Kui Wealth Partners, and I'll be taking you through today's event. So what I'll do is I'll just start by sharing my screen, and hopefully everyone can see that. If you have any problems, just pop a comment in the chat that's been enabled. As we go through, if you do have any questions on anything that we talk about today, please feel free to pop them in either the Q&A or the chat, and we'll get to those at the end. All right, before we dive in, just a quick but important reminder that everything we discuss today is general information only. It's designed to help you understand the principles behind retirement investing, not to provide personal advice. If you'd like to see how these concepts apply to your situation, your wealth partner is the best person to cover that. All right, so when you're working, generally your focus is clear. It's to grow your income, pay down your debt, and build your superannuation. So at that point, you're in what we call the accumulation phase. So generally, your investment time horizon is long, and short-term market swings matter less because you're still contributing regularly. But once you retire, the focus starts to change completely. It becomes less about growing wealth and more about managing it. It's about ensuring that your capital lasts, that your income's reliable, and that you can spend confidently without fear of running out. We also move through different stages in retirement as well. So we've got an active phase where travel and lifestyle spending are typically higher, and later a passive phase where priorities do tend to shift from shift more to comfort and care. Now, every client's going to be different. The age at which they switch from the active phase to passive phase will move, and the extent to which people spend on travel and lifestyle in that active phase can vary significantly from one client to another. Where we fit in, well, our job is to help sort of manage that transition through the different phases. So through the working life into active retirement and then into passive retirement, so that your money does keep working effectively for you. All right, now, when we start looking at investing in retirement, it brings a very different set of risks compared to what you see when you're accumulating your wealth. So there's three major risks that we need to understand. Now, first of all, we've got longevity risk. So this is the risk of outliving your retirement savings. With Australians now living longer, this is becoming one of the biggest financial risks that we manage. We've then got sequencing risk, which is the risk of experiencing poor returns early in retirement, right when you're starting to draw an income. Now, that timing can have quite a lasting impact. And then we've also got inflation risk. So this is often referred to as the silent one. Over time, rising prices can erode your purchasing power if your investments don't grow fast enough to keep up with that. So managing these risks is the foundation of how we design the retirement strategies at Kui Wealth Partners. Now, when Allianz Life Insurance did a survey and they asked people which they fear more, is it death or running out of money? Now, 61% of retirees said it was running out of money. So it's quite a startling statistic, but look, it makes sense. Retirement now can last 25, 30 years or even longer. And the biggest challenge is uncertainty. We just simply don't know how long we'll need our retirement savings to be able to last. So, on the flip side, if you do invest too conservatively, you risk that your capital's not going to keep up with inflation. If we invest too aggressively, if we have a downturn at the wrong time, that could erode your retirement savings or your capital base permanently. So that's why our focus is on the balance. We've got to hold enough growth assets to maintain purchasing power to keep up with inflation. But we also need enough in defensive assets to be able to protect your income along the way. Now, one thing that we can be certain of is that markets will continue to rise and fall. So corrections are not only unavoidable, they're inevitable. So if we look back over the last 30 years, there's a long list of events that have spooked investors and investment markets. We've had the dot-com crash, we've had the GFC, we've had Brexit, we've had COVID, we've had inflation shocks. More recently, we've had the banking collapses of like Silicon Valley Bank. Yet every one of these has been followed by a recovery in markets. Now, our job as financial advisors isn't to try and avoid market corrections. That's impossible. Our job is to build portfolios that can withstand them. So when you're working and you're contributing regularly to your superannuation or to your retirement savings, a market downturn can be quite helpful because you're buying cheaper investments or you're buying your investments at a lower cost. But once you retire and you start drawing an income stream, it's a very different situation. You're selling assets to fund living expenses, and that's where sequencing risk comes in. So the question isn't when will the next market downturn happen, it's actually how is your portfolio structured to be able to ride it out. So this table here helps show the real world impact of sequencing risk. So what we've got is two investors. We've got portfolio A and portfolio B. Now there's a lot of numbers on the screen. I'm going to try and run through it as high level as I can while still doing justice to the point here. On the left-hand side, so the table on the left, what we've got is two investors. They both start with the same amount of money. It's $100,000. They earn the same average return from age 41 through to age 65. But the only difference is the order in which they experience those returns. So the investor on the left-hand side has a shocking start, minus 12, minus 21, minus 14. The investor on the right has a fantastic start, but they finish with a poor rate of return, whereas the investor on the left started really poor, finished really strongly. Both averaged 8%. It's just a difference in the order of returns. Now, what happens there is in the accumulation years, whilst you're still saving, it really doesn't matter what the sequence of returns is if the average is the same. Both investors end up with the same balance by retirement. But when we jump to the right-hand side and we start drawing an income, that sequence of returns becomes critical. So what happens with portfolio A is that they have some pretty poor returns early in retirement, basically a few bad years right after they start taking withdrawals. Portfolio B has some really good years at the start, and their bad years don't happen until later on. Now, even though their average returns from age 66 through to 90 are the same, the outcomes couldn't be more different. The retiree that has early negative returns can run out of money by age 81, where the retiree who has really strong returns still has $3.3 million when the first investor or when investor A had run out of money. So the problem was that investor A had run out of money before the good investment returns had come along, or they'd drawn down on their portfolio. So when there was a market recovery, they had less money left over and invested to actually benefit from that recovery. So what we're seeing on our screen here is that's sequencing risk. So it's not just a concept on a spreadsheet. We see, some people go and say, if I earn 7% per annum every year and I'm taking X amount of withdrawals, I'll be fine. The reality is you will never get 7% per annum consistently every single year. There's going to be double-digit positives, maybe some double-digit negatives. So we've got to take this into account because it can be the difference between being comfortable in your late 70s or having to drastically cut back on your lifestyle. So what we do is we design portfolios that are there to separate short-term income needs from longer-term growth assets. Now, the idea behind that is that when the next downturn hits, and it will, your income needs are still funded safely and your growth assets have got time to recover before they need to be touched. Right, so just moving on to the inflation risk side of things. As we said before, it's one of the most silent and underestimated risks in retirement. So even modest inflation can have a major impact. If inflation averages just 3% a year, something that costs you $1 today will cost you $1.56 in 15 years' time. So that doesn't sound like much, but when we go and spread that across every bill that you have to pay, every grocery shop, every holiday, it does compound into real erosion of your lifestyle. So this chart here actually shows what would have happened with a term deposit if you've been just investing in term deposits over 30 years before and after adjusting for inflation. Now, if you started with $100,000 and you kept reinvesting into term deposits and reinvesting the interest you've earned, it would have grown to about $383,000 by 2025. Now, that sounds great. But once we adjust for inflation, the real value of that original 100,000 is 143,000. So over 30 years, the total return is only up 40% total, right? So what that means is that term deposits are only just giving us a rate of return slightly above inflation. Now, of course, if we're then taking the interest that's earned from term deposits to put that into spending, then we're not getting that compounding effect. So it would be much worse than what we're seeing on the screen. So the point that we're raising here is the danger of being too defensive in retirement is real as well. All right. Now, we're just going to make it a little bit more tangible. So the last point I want to talk about on inflation here is the chart showing how the prices of everyday items, bread, milk, butter, and even tea have changed over 10 years. Look, some things have doubled, like butter. Others have fluctuated. As supply chains costs and the overall, price of things moves. But what you can see is the overall trend is clear. What you could buy for $100 in 2010 costs far more today. The thing is, though, inflation doesn't hit everything evenly. Essentials like groceries, healthcare, and insurance often rise faster than the average inflation rate. And the issue there is that's where retirees are going to feel it most. So it's why when we look at portfolio construction, sitting in cash or term deposits really isn't a long-term solution. Reliable income does matter, yes, but it's also protecting the real value, so the inflation-adjusted value of your capital. So that's why when we're looking at retirement strategy design, and especially when we're looking at the time horizon investing framework that I'm going to go over in a moment, we need to include assets that can grow faster than inflation over the long run. It's not necessarily about taking more risk, it's just about protecting your future lifestyle. All right, so how do we manage these risks? So we look at, we've got to manage longevity, sequencing, and inflation risks. How do we manage all three at the same time? So that's where we use time horizon investing, or THI. So instead of treating your retirement savings as one big pool, what we can do now is we can split it across three distinct buckets. So first up, we create a short-term portfolio. This is designed to go and fund the next few years of income needs. It's invested conservatively in cash and fixed income. We then have a medium-term portfolio, which is invested in a balance of growth and defensive assets. It's there to replenish the short-term bucket over time. Then lastly, we've got the long-term portfolio. So that's invested mostly in growth assets like shares and property. It's there to drive returns and offset inflation over the long run. So what this approach does is it gives us structure to retirement strategy. It allows us to protect the lifestyle today whilst allowing capital to keep working for tomorrow. Now, we're going to have a look at a case study as to how this works. Now, you might notice here that the case study here starts in 1972, and there is a reason for that. We've chosen this period because it's one of the toughest starting points in history for a retiree. The early 1970s, we had high inflation, we had the oil crisis, we had a series of market downturns. Returns were poor for many years, and it took well over a decade for markets to properly recover. So 1972 gives us a realistic stress test. We can see not just the initial impact of bad markets, but how those effects play out over a full retirement horizon. By contrast, if we tried to use the GFC for this, it's just simply too recent. We don't yet have enough decades of data to see the long-term compounding effect of the GFC in the same way. We're only 17 years post-GFC. So in this case, what we're looking at here is both retirees starting with the same balance, $1 million, and they're drawing the same income, $70,000 a year, every year consistently. One of the investors, which is the one in light grey, follows a traditional balanced strategy. The other investor follows THI, or time horizon investing, which is the solid black bars. Now, the results are quite different. So despite facing those early poor years, the THI, or time horizon investing approach, holds up much better because short-term income is being drawn from defensive assets. We're not selling down growth assets that are temporarily down in value. So this is a perfect example of how sequencing risk works in real life, and by how structuring your capital by a time horizon investing strategy can turn volatile market periods into something that's manageable. Now, admittedly, person in the light grey still did all right. Their money lasted to 94, but I think most people would rather be in the alternate situation with the solid black bars and still have over 50% of their retirement savings still there. Now, one of the reasons why we need to really not target running out of money at retirement is we don't know how long someone's going to live. Statistically speaking, you look at a couple, one person's going to be alive into their early 90s. We've also got additional things like aged care costs that can come into it. So to have a bit of extra capital available certainly isn't going to harm anyone. All right, so it's just something that we need to be mindful of in terms of the two different outcomes. Now, the beauty of this approach is that it's structured, it's disciplined, and it's completely practical. So our preferred investment platform that we're going to start moving clients over to from about the 29th of October, we should be live and ready to go, allows us to be able to implement these kind of strategies with precision. All right, so through our preferred platforms, we can set distribution instructions so that income from the short-term portfolio is paid out to a cash account to fund your living expenses, whilst the medium and long-term portfolios can be automatically reinvested. We can define sell-down sequences, ensuring that withdrawals always come from the short-term portfolio first, and we can clearly label each portfolio for short, medium, and long-term purposes so that clients can see exactly which part of their portfolio is working for each intended purpose. The whole idea behind this is that it's transparent, it's automated, and designed to keep your strategy aligned without having any emotional intervention. And what we do is we then review your plan each year, and we do rebalance. So we top up the short-term portfolio from growth assets when markets have performed well, or we can defer that rebalancing during downturns to give those growth assets some time to recover. So really what we're aiming to do here is manage risk intelligently. We're not there to try and guess markets, but we're going to structure it for the timeframes over which withdrawals need to be taken. All right. Now, another approach, which is what we've historically employed in the past, is income investing. So we've traditionally gone with that path as opposed to time horizon investing, which is what we've just spoken about. And that's because of product and platform limitations that we've historically had. Now, there's been a lot of technological improvement with platforms, cost improvements as well, and also the ability to implement different time horizon portfolios over the last few years. So that's why we've shifted it to this approach. But the income approach that we've historically used, what happens there is rather than separating assets into time horizons, this strategy focuses on holding investments that generate consistent income, typically around 5% per annum. Now, the biggest problem with that is targeting 5% per annum. If we go back 5-10 years, we were able to do that. We were able to invest with a dividend yield on the ASX of over 5%. Residential property markets, we were able to find locations with yields of over 5%. Unfortunately, what has happened is property prices have gone up, so too have share prices. But dividends and rent haven't kept pace. So 5% per annum income is very, very difficult to come by unless we're pushing into quite high risk areas of fixed income markets, or we need to basically confine ourselves to very high dividend paying investments or high income paying investments. The issue with that is that a lot of the total return that we've seen from markets more recently has not necessarily come from the biggest dividend payers. It's come from a lot of the US tech stocks, that have rallied quite strongly off innovation, AI. So their share prices have gone up considerably. There's strong returns to be earned there, but the dividends just aren't there. So if we're saying, well, we can't invest in those stocks because we want income, well, then we're confined to narrow pockets of the Australian share market. And interestingly, even the ASX 200 right now, the dividend yield on that is actually less than the yield on government bonds, which is the first time it's happened since the 1990s. So this is why we're starting to say, well, the income investing strategy, theoretically fantastic, very challenging to work in the current environment. So that's where time horizon investing has become our preferred approach. Now, you can still run with income investing. However, it really is going to require someone who's got a much higher risk tolerance, because we're going to have to concentrate investments into those high yielding stocks. It does provide a little bit of simplicity as well, in that we don't have to structure 3 buckets, but it's going to be a much more concentrated portfolio when we're trying to target that rate of return. If we can do it, though, it still sort of makes sense when we compare it to, say, just investing in term deposits. And that's when we have a look at this chart here, what it does is it tracks income and capital returns from 1980 through to 2022. So we've got 4 decades of data in here. It is a useful reminder of how both income-focused and time horizon-based strategies perform through different market conditions. What we see in this chart is that when we're going through periods of high inflation, like in the early 80s, the 87 crash, and then also some of the market corrections like the dot-com bust, GFC, COVID, through all of those, the portfolios maintained a clear structure. So people don't chop and change and go and pull back to term deposits, just stay in the high income yielding investments that are there to deliver constant income and long-term capital growth. Now, the point is, with this kind of strategy, there have been corrections. We can see big dips along the way, but markets tend to bounce back, but sometimes that recovery can take years. So if we're going to use this kind of strategy, it requires a lot of discipline, but you've got to stay invested throughout the long term to benefit from that recovery. So income investing, where the focus is on that yield and stability, can provide a steady cash flow, but you are going to be more exposed to short-term market moves because the capital isn't ring-fenced for different time horizons. Whereas the time horizon investing strategy that we're looking to shift to, but move retirees to now, uses that separation between the short, the medium, and the long-term portfolios to manage those ups and downs just with more intent. So, look, whichever approach gets adopted for you, the key takeaway is that we do need to maintain discipline and not overreact to market corrections. Now, that's where our role comes in. It's around making sure that your portfolio remains aligned to your strategy, automatically reinvesting where it's needed. We distribute income when it's planned, and we keep everything working along quietly in the background just so that you can keep enjoying your retirement. All right, so look, that's pretty well all I wanted to go through today. If you've got any questions, please feel free to reach out either to me or to your wealth partner. Happy to go through it and have a chat about how it might impact you. But otherwise, thank you everyone for joining me, and enjoy the rest of your day. Cheers. Bye.